Hi, I'm Aaron, and today I'm going to explain to you what service strategy is and the use of it to organisations and businesses. So basically, service strategy shows organisations how to transform service management from an organisational capability into an asset. Service strategy is about the selection of services a service provider will offer to customers. The first one is providing value to customers. This meaning that it will increase the chance of Samsung selling products, as a value to customers will convince the customers to purchase products. Another example would be the price and quality of the product that is sold by the company. Also, meeting customer needs. The benefit that this would have to Samsung, the organisation, would be the increase in sales, the increase in profit, and the increase in market share. So what does service strategy does to organisations? Basically, it clarifies the relationship between the services that are offered, the systems, the processes, the business models, the strategies and objectives within the organisation. So the 5 main objectives which are included in Samsung is business stakeholder value provided, differentiate the organisation, solid case for investment, resolve conflicting demands for services and improve service quality by planning. The processes are financial management for IT services, service portfolio management and demand management. I'm going to go into more detail to what financial management is. Basically, it involves 3 activities which are carried out inside the organisation. The first one is budgeting, which predicts the expected future revenue for the business, and this is created on an annual basis. There's IT accounting, which enables IT organisations to track how much is spent. This is worked out by fixed cost versus variable costs and cost types such as hardware and software. Also, service valuation, so it teams up with service level management to make a mutual agreement with businesses regarding what a service is. Moving on to service portfolio management, it basically describes service providers in terms of a business value, also business needs and how they can be met and are articulated. Demand management is a critical aspect of service management. Basically, if poorly managed is a source risk for service providers because of the uncertainty of demand. There's 3 categories inside service portfolio. The first one is service pipeline, so something in development. Service catalogue, which is available for deployment, and retired services, which is basically service which no longer happens inside the organisation. So value to organisation and businesses. Basically, it helps guide organisations on how to design and implement service management. It sets principles for developing service management, such as guidelines and processes across the lifestyle. The objectives and expectations are set for the customers. The opportunities are prioritised in order. The costs are managed and a strategy is planned.
Value is the importance or worth of something. With regards to business, value is a generic term with many components and covers a whole host of items valuable to the company. The list contains both internal and external values such as employee value and shareholder value. Internal values are ones which the business has control over. The employee value is your worth to the company. If you are working as a programmer, your value is likely to be quite high as you cannot be replaced by automation and there is an industry shortage of programmers. However, if you are working in a factory making toys, then your value may be less as you could possibly be replaced by machines which may increase production. External values are ones which the business has no control over. Supplier value is how important your suppliers are to you. If your business is food outlets, then there is a wide range of suppliers. This means that suppliers are easily replaceable. However, for Samsung, there are only a few suppliers of the chips for their phones and therefore are important. Service delivers value to the customer. Service strategy ensures services are offering value and that they are aligned with the main objectives of the business. It also ensures the service provider is able to deal with the costs and any risks that arise with their service. Quality is important because if your products are faulty, the customer may shop at one of your competitors. Prices are valuable as if they are too high, then this could discourage customers. Service is important as in retail shops. The staff are the face of the company and poor service may give off the wrong impression.
For this part of service strategy, I will be looking at the concepts and models. These are business case, ROI, VOI, and value. First, let's look at business case. Well, a business case is a document that justifies an investment in change, a change that delivers value, for example, an improvement in IT services. A good business case will ensure that parties are dedicated and engaged across an organization, and ultimately ensure a greater chance of a successful investment in change. It is a useful approach to review and update the business case at selective points to ensure that the objectives are still valid and that it does what it is supposed to do. On the screen, you'll be able to see the aims of a business case, which include explaining the reason for change and explaining the proposed projects that permit the change to happen. The business case also explains why a change is worth investing in. A business case helps with gaining commitment to a project or change at senior levels, and it provides reassurance that staff involved can manage the change. During a project, the business case can be utilized in different ways. It can be used to monitor progress, evaluate key outcomes, verify if the requirements for change are within scope, verify that the change continues to justify the effort and resources being used. Now let's look at ROI and VOI. ROI stands for return on investment, whereas VOI stands for value on investment. ROI is a measure of hard or tangible benefits from technology initiatives. VOI is the measure of the total value of soft or intangible benefits derived from technology initiatives. ROI is also a part of VOI. Some other aspects of VOI include knowledge, networks, collaborations, and communities of practice. Now let's look at value. Utility and warranty are the two components that add value to services. In order to ensure and provide value, services must have utility and warranty. Utility, or fitness of purpose, is how able a service is to take away constraints or increase the performance of customers. Whereas warranty, or fitness of use, is how able a service is to run reliably. Most technological products today come with warranties. For example, the warranty of Samsung products vary from 12 to 36 months depending on the product, whether it's a mobile phone, audio-visual product like a TV, or an IT and business product.
Another part of the service strategy lifecycle are service assets. The definition of service assets are any resource or capability. The assets of a service provider include anything that could contribute to the delivery of a service. In other words, these are the supplies and the limitations of what the service providers can actually give to the customer. They consist of numerous amounts of factors that could enhance the supply of a service. Other examples of assets include management and the people involved in the business, organization, processes, knowledge and information, infrastructure, and capital. When we reference resources, these include anything ranging from people to money and even infrastructure. In regards to Samsung, their service assets would be the staff. This is as they would have to provide a high-quality customer service when dealing with customer queries and issues. By having good customer service, this may give them a market niche, as customers may not feel frustrated when trying to deal with issues they may have, or as their competitors may not provide the same level of service. What needs to be considered before starting a service strategy? The objectives and aims of the business need to be carefully thought of, and these can include enhancing the quality of service, creating a niche for the brand, and gaining stakeholder value for the firm. In addition, you need to consider whether your assets will be safe, and will the service strategy be likely to generate profit.
What is service portfolio? Service portfolio records IT services over time in a business. Within the service portfolio, there is essential information about the IT services past, present and future. Service portfolio is most useful when IT services are undergoing change by defining what should be maintained in terms of pricing, costs, risk and priority. There are three major parts to service portfolio. The first part is the service pipeline. This is the strategy the service provider should take. There are also services that are planned or being developed. This includes services that have been asked for and services that are currently at the evaluation stage. The requirements are identified, then analysed on factors such as cost, risk, estimated business value. After analysis, the requested services are approved or rejected. For example, Samsung will analyse their services that the customer requires. These requirements are then defined, approved, and then charted. The service catalogue are services that are currently available to customers. These are services that have been approved of or are in development, and this includes outsourced, co-outsourced, and managed services. There are many attributes that need to be maintained in the service catalogue, such as the service description, policies, SLAs, ordering and request procedures, support terms and conditions, pricing and chargeback. The feasibility of services from the service pipeline is assessed, and the services are developed, built and tested. These services then become operational and resources are provided for help. The retired services are the review of services that should no longer be available to the customer. For example, Samsung will analyse services that are no longer required for the customer, and after this analysis, certain services that they usually provide will be retired. The service portfolio helps the service provider gain knowledge on how the resources maximise service value given to the customers.
Was another process of the service strategy. This will allow the service provider and the customer to communicate on the value of products. This will allow the service provider to offer a value towards the customer in the form of products and services. Related to Samsung will make sure that the technology that's given to the customers is of efficient need and offers high value. Processes of service belt demand management. Samsung need to make sure they meet customer needs. If not, it will result into risk or cost. Samsung will also look at the pattern of business activity, what type of users ask for services. For example, if one of the technologies is not working, a customer will come back and ask for recommendation why it's not working, and then they'll give them that additional information. User characteristics as well. They'll look in a database at what type of services people ask for. Therefore, they can look back at their strategy and look at the different methods they use in order to make sure that the product doesn't perform the same transaction again. Also, look at the ICT financial management, looking at how the service provider tracking how much money the service provider will pay for any new resources. Also, planning out how the service provider will spend the money and looking towards how much money is charged for the customer services.